Good morning, everyone. Hope you had a good holiday. I would like to call the meeting to order. It is about 5 minutes to 10 here in Brooklyn at 335 Adams Street, Suite 2200, and this is the New York City Employees Retirement System Investment Meeting. And Larry, I'll hand it over to you.
Roll call.
Oh, sorry. Okay.
Chair?
Here.
Here. Bill Lopez?
Present.
Public Advocate's Office?
Here.
Borough President Manhattan?
Here.
Borough President Brooklyn?
Here.
Borough President Queens?
Here.
Borough President Staten Island?
Present.
Borough President Bronx?
Here.
International Brotherhood of Teamsters?
Here.
Transport Workers Union?
Here.
District Council 37.
Here.
Thank you. And now I will hand it over to Larry.
Thank you. So we have a very short public session today. We just really have to go through the March results. Does everybody have their color package? Yeah, good? Okay. Just a few brief comments before I walk you through a couple of numbers. Basically, March and April are more of the same. The U.S. economy is sort of slowly drifting up. Europe is in a recession. China seems to be growing at 6 to 8%, depending on who you believe. Let's call it 7. And Japan continues its very aggressive monetary policy, the ultimate QE, if you will, doubling their money supply. So all those things are good for equity markets. The Fed has said, I want you to take more risk, so people are taking more risk. So the answer is, when you have low interest rates, you go into the stock market. So that's been the story January, February, March. It was also the story in April. Last week, the Fed made some comments that sort of confused some people, but they're starting to talk about when they come off buying $85 billion a month of bonds. At some point they have to come off, but they don't want to be the people that are to blame for slowing down the slow growth of the U.S. economy. So they're going to be very ginger, taking their foot off the pedal, and they're trying to tell people we're going to take our foot off and put our foot back on if we need to, but we're not going to be responsible for perhaps having a double-dip recession, not that they ever mentioned that word. So again, reading between the lines, it's very, very accommodative monetary policy for the foreseeable future, and when the foreseeable future changes, we'll get back to you. So what that means, if you go to page 34, 34 is the month of March. These are the markets. Again, if you look at the far left-hand column, the top block is the U.S. stock market, basically up 4% for the month. The next block of numbers are international markets. You can see that IFA was up about 1%. Emerging markets was down about 2%. The next block is sort of the government market was sort of flat, up a little, and the high yield market was up 1%. So if everything is up, we're going to be making some money. If you flip forward, and we don't have the numbers that go with this, but you can see April, the next page, page 35, April was also generally up. So next month we'll have another good meeting. The U.S. markets are up about 1.5%. IFA rebounded, was up about 5%. Emerging markets up about 1%. Government's high grades up about, let's call it 1 to 2, and the high yield market was up about 2-ish. So again, we got back-to-back months coming through. March was good. April's going to be good. May has been a little bumpy, but my guess is May will end up good as well. So all good numbers. So if you flip to page 30 now, you can see how we're set up as always. We're set up generally the same. We're overweight the U.S. stock market, which has been very good to us. We're overweight high yield, which has also been very good to us, but we're slowly starting to lighten that up. And we're underweight U.S. governments and core plus 5. All about the same. We're a little out of the band in tips. We'll fix that shortly. But in general, we're within the ranges. We're close enough. If you flip then to page 36, all those ups led to us being up about 1.8% in the month of March. takes our fiscal year date to about 12.5%, which is right in the middle. Again, we're going to be up in April, so that should get us into the 13, 14. And so far in May, we're up. So my guess, if I had to guess, we're pushing 14.5%, 15% year to date through today, let's say. And, you know, we only have 6 weeks left or 5 weeks left in the fiscal year. I'm optimistic that we'll beat the target of 7% net. So how does that look in the long run? If you go to page 27, 27, this is the month of the fund, and these are net of distributions, so we're up to about 46.6 billion, highest ever. And again, the next couple of months so far look good. At least April looks good, so we're probably pushing 48-ish billion dollars, up from 42-ish at the beginning of the year. If you go to the next page, 28, longer term snapshot, which is 10 years through March 31. Again, this year's way up over trend. We've now taken our 10-year number, Mr. North, up to 8.7%, looking good. And the past is not a precursor of future results, but so far, looking okay for this fiscal year. Are there any questions? Okay, nothing like good results. That ends our agenda for the public session.
Okay, thank you, Larry. Do we have a motion to exit the public session and move into executive session?
So moved.
Do we have a second?
Second.
All in favor?
Aye.
Aye. Any opposed? Okay, thank you. We'll just take a few seconds for the cameras.